or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and trading services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, here we go. Fantastic. Now, what do I have to do? I have to share my screen. That's my next step. Share my desktop. One day I'll get this to be like a routine, but as it stands now, after doing it for 6 months, I still can't remember the steps. All right, let's see what happens now. Oh. Okay, you're probably looking at the very boring "thank you for using WebEx" screen. Let's move over to Power Options so we can take a look at our portfolio, and I got to refresh it first. So here, oh, darn. I would have rather shown you that. Hang on, let's see if we can do that. There we go. All right, so last week, I don't know what day this was. Oh, here you go, 10/14. So last Tuesday, this is the last time we were doing the webinar. The short-term portfolio was up 80%, and we were mostly in cash. And we had these, oh, I see. We had well, we had essentially the setup we had now. We bought back some of those short calls. We still had these SQQ short calls. Those were kind of risky. And these fast calls were killing us. I think they still kind of are a little bit. But nothing so bad. So we were up 80% at the time. And so we're going to refresh it now and see what happens. This morning we were up like 92%. I'm not sure where we are now, though. Client login. Oh, you know what? It's not going to be right because I haven't updated that thing yet. I got to, hang on, my portfolio, profit and loss. Oh, I can make that adjustment now, though, so let's see what happens. I didn't take out those things that we sold. Look at that long-term portfolio coming back nicely, 17.4%. So the short-term portfolio, still 92%, but we sold, what did we do? Oh, yeah. We sold these guys for $9, or $9.40 now, but we sold them for $9, so we've got to put that in. So we're going to close that leg to make sure we know that we don't have it anymore. All right, so earlier we took this leg out. This is very important. We took it out for $9. And we did that because we wanted to get more bearish, because we figured 1100 would be kind of toppy on the Russell, and we'll get into that next. So let's take a look at that and see how that affects us. Probably won't have much of an effect, 40 cents. Was that $1,200, right? Oh, well, that was painful. It dropped us down a little bit below 91%. Still low 91%. 91% is good, and the key thing here is we're almost all cash. 189,000 in cash means, I mean, essentially 100% of the 90% that we're up is basically cash. What we have, though, is remaining positions. This one, of course, is a biggie. It's negative cash. We have a cash credit in our account, and we're currently down 100% on that cash credit. But otherwise, these take up very little cash. I mean, look at this thing. This is 50 units, but it's only, what, like 250 a unit. So it's like 10,000 bucks of cash being used on that one, maybe 10,000 being used over there. So, you know, we have these incredibly aggressive hedges, but we're not using much cash to make those hedges. Let's see. I'm sorry, I don't have the chat box up. All right. I hope people can hear me. Nobody's saying hello or nothing. I don't hear. Nobody has any questions. That drives me nuts. Must be a question. Somebody say hi, just so I know you're there. Get rid of that thing. Okay. Who? Yes, you, yo. Thank you. So, you know, I mean, you know, what's the point of having a chat thing if I'm just going to go blah, 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 and nobody's going to talk to me? That doesn't make any sense. Where are we? Okay. So moving on. So point being, here's the thing. the goal of the short-term portfolio is to build up this cash reserve, because right now, if the market crashes, we're going to be in fantastic shape. I don't give a crap if the long-term portfolio drops another $50,000 because frankly, we have, if it drops right now because we're bearish in the short-term portfolio, we'll end up with like $250,000 in cash in the short-term portfolio. And what do? We take the $150,000 profit from the short-term portfolio, put it into the income portfolio and the long-term portfolio, depending on which one you're hedging it with, and we then use that cash to buy more stuff. That's the point of this system. You see, by keeping the bearish portfolio separately and covering your bullish portfolios, you are able to take advantage of these short-term market moves with the aggressive stuff while really not touching your other portfolio. And even when there is a big downturn, if we play it right, and so far we've been playing it, pretty well. I mean, getting up 90% for the year, playing it right. So far we've been playing it correctly, and if you play it correctly, when you hit that downturn, you've got a ton of cash and you're ready to go shopping. That's what we dream about. So, because as a long-term investor, your primary goal is to own stock, right? Down the road, you expect to own a lot of stock. You want to be Warren Buffett, okay? Although Warren Buffett doesn't want to be Warren Buffett this week. He's got to be down about $2–3 billion on IBM and Coca-Cola and McDonald's. He owns all that crap. It's doing terribly right now. So, but I mean, ideally, that's what you want. You want to be the guy who's got $50 billion and took a $3 billion hit in a week because your stocks didn't perform. And we build up to that, and we buy these stocks cheaply by taking advantage of the dips, and we take advantage of the dips because we have this bearish portfolio that makes a lot of money when the market goes down. So even though we're sitting on a long-term portfolio that maybe goes down 10% like the income portfolio did, that's 10% is only $50,000, but we made $100,000 on our short-term portfolio. So we can actually replace the $50,000 with the money that we made on the short-term portfolio, and we could then use more money and have more buying power for the move back up. Craig says, those of us who have less resources than you, who have all of it in single portfolios, they have formulas for how much hedge. It's not about resources, because really it's just the way I like to wall it off. I mean, I highly, highly recommend this. It's so easy in Thinkorswim to set up a second portfolio. Oh, excuse me a second. All right. Sorry about that. It's so easy in Thinkorswim to set up a second portfolio, and all you got to do is flip between them. Thank you. Let's see, where is it? Oh, I see. Wait a minute. Hang on. Well, I can't show you the account because that's not right. I can't do that. Okay. Anyway, but up around where the account is, there's a little thing, and all you got to do is switch the account. You can go back and forth if you have multiple accounts set up. And so you just go from one to the other. You keep your certain kinds of trade in one, certain kind of trades in another. You can have a hedge ratio, and in fact, frankly, because of the way our portfolios were going, the hedging we had in the short-term portfolio wasn't enough for the income portfolio because it was losing money faster than the long-term portfolio. So we did actually specifically weight that one a little bit by adding some, we added some SQQs to the income portfolio. So we kind of overweighted that one because of just the nature. It wasn't exactly the same as the LTP. It was a little bit more hedged due to the fact that we sold a lot more premium. When the premium started going up, we got screwed. Oh, that one needs to be fixed also because I didn't take in. I don't think I took out the. Oh no, I did that. Okay. So this one was paired, and we took advantage and sold when the thing was down. We sold the other one. Got to close this out too. So anyway, so that's rare though. We don't usually do that, but it's the same principle. In other words, if you have one portfolio, all you got to do is take the same trades in the same ratio, and really keep in mind though that the key to this thing is that the short-term portfolio is to start with only 20% of the size of the long-term portfolio. In other words, these aggressive hedges that we put on, these moves, they're all within the context of using only 20% of our total portfolio to do that. So the most, because these are both long-term strategies. You know, if I was trying to make money in a year, I would probably hedge a little bit. I'd probably take about a third of my money into the more active bearish portfolio. But since we have a long-term vision on the income portfolio and a long-term vision on the long-term portfolio, I don't really care if they go down 10% or 20% in a year. It's not my big concern as long as they're still stocks I like, as long as I'm still in positions of stocks I like. So in other words, let's see. Okay. If you look at the long-term, if you look at the income portfolio, which is more beaten up than the other, okay, here we go. All right, so if you look at the income portfolio, it's not up too much. In fact, it's probably not up at all because somehow this GTAP position is misdone. And I got to see if I can figure out how to fix it. But I think because they went to a Q, it screwed up the numbers. Oh no, it's all screwed up. So it's giving a false reading. It certainly we should be down, probably flat for the year, not or maybe just a little bit better than flat for the year. But in any case, if we look at the positions where we are losing money, all right, what are the consequences of our losses? So here we go. We have GoGo, and wait. Oh, we bought puts on GoGo. Why did we do that here? Oh, we sold the puts on GoGo. Silly me. We sold the puts on GoGo. So what's the situation here? We're down 37%. Not that it's a big number, but we're down 37%. So if the market is going down and a position like that's hurting us, what are the consequences of that position? The consequence of this position is that in February, I'm going to own GoGo. I sold the $17 put for $2, so I'm going to own GoGo for $15. If I meant to do that, then that's not really a downside, is it? I wanted to own GoGo for $15. I wanted to establish a position long-term in GoGo, but only if I got to buy GoGo cheap. So let's take a look at this. We bought this in 9/17. All right, so let's go to GoGo. So on 9/17, GoGo was at right about here at $18, okay? And on 9/17, we said, well, we kind of like GoGo, but we really would like them if they get down to 15. That's when we're going to like GoGo. We don't like them up. I didn't want to buy them at 18, but I said, you know what? If they get to 15, I'll buy them. So what do? On that date, we decided that since we think 15 is a good price, we sold the $17 puts for $2. So we either get to buy GoGo for $15, or we end up making $2. Those are our two possibilities. If I make $2 on a net $15 entry on the stock in between September and February, that's a pretty good rate of return. That's 2/15 is I don't know, what is that? 15%. So it's like 15% in 6 months. So my worst case is I own GoGo for $15, which is what I wanted to do in the first place. My best case, or my positive case, is that I make a net 30% annual rate of return off that put sale. I don't need a lot of hedging for that kind of stuff, frankly. So like I said, there are long-term consequences in this portfolio. Here we have Hovnavian. We're down 50% on that, but the net entry on Hovnavian, we sold $5 puts for $130. So that's net $370. Hovnavian's at $383. It's at the point we want. It's only at the point we wanted to buy it at. So I don't give a crap if this thing tells me I'm down 50% and losing $2,600. I want to buy Hovnavian for this price. This is not a negative to me. So you know, this is part of the thing about portfolios. You get fixated. People get fixated on these, on the current prices and the rate of return, whatever. But you have to remember why you're in these positions. Because I don't need to hedge that $2,600 loss. It's not a loss so far. It's where I wanted to buy Hovnavian. It's now at the price I agreed to buy it at. All right, so you can't start panicking over what your portfolio balance is. We get into these positions intending to buy more. These guys were in for the dividends, and again, we sell puts and we intend to buy more. So ABB, we sold the March $22 puts for $1, and that's net $21, right? I want to buy ABB for $21 because it's a great thing. I can sell puts, I can sell calls against it. So it says we're down 105%, but that's not relevant to the position. Okay, the position is right where we thought it would be. We bought the stock for $22.85. We sold $2 in puts and calls. So we bought it for like $21. It's at $21. It's where we decide. It's where we made a value decision to say we like to be in ABB. We decided we wanted ABB, and we called a bottom at 21. Now we had a big market sell-off. We didn't. Don't forget at the time on 821. Let's go to ABB. Well, we know where it was because that's where we bought it. So ABB was here on August 21st. We said we'd like to buy it for 21. We created a situation that gives us a stock at 21. Now it hit 21. It tested 20, in fact, and went back up. We didn't know that was going to happen, though. It could have just kept going along here and gone up and up and up, and we would have said, damn, we never got a chance to buy it. So we took a chance, but by taking a chance, we gave ourselves a big fat discount from this price to here. This is where we discounted ourselves to, right where it is right now. And this is the price that we felt was going to hold. If we don't think the price is going to hold, we wouldn't be getting in the position in the first place. You know, and now Cliffs is actually below where we thought it would be. We're showing a pretty big loss here. But what's the reality? The reality is we bought Cliffs for $16.50. We sold these guys for $5 and these guys for $1.60. So let's call that $7, let's say. So we bought Cliffs for about $10, $9.50, $10, let's say. It's at 834. It's not a crisis. We bought 1,000 shares for $10, and they're now at 834. I'm sorry, we bought 2,000 shares because we'll be assigned ultimately. Okay, but what we promised to do is we promised to own 2,000 shares of Cliffs for $10. And if they're below $10, we'll lose $2,000 minus $1.50 is $3,000. It's not 8,200 plus 17. It's not, you know, we're showing a $10,000 loss here, but this position, if it closed today, is down $3,000. All right. If you're a long-term investor, you have to understand what it is you've done. What did you buy? I'm trying to think of a good way to put this because it's important. You have to understand your portfolio. So the point was, though, that I'm saying this is a $500,000 portfolio. The short-term portfolio is $100,000. So if you took inside of this portfolio, and it doesn't matter what the size is, you have $50,000 portfolio. The point is you have $50,000 of long-term and $10,000 of short-term that you're mostly going to want to use to hedge it. The short-term portfolio isn't supposed to be for gambling. It's for finding ways to balance your long-term positions so that if your long-term positions go bad, your bullish positions go bad, you'll have something. Now, occasionally in the short-term portfolio, we do pick a long, like we just did oil. We did USO for long. You know, we do gamble once in a while. We did an earnings play on Netflix, you know, things like that, because it's fun and because we can. You know, it's a place to put it. We don't really have another place to put our aggressive trades. That's where we put them. But that's not really the purpose. The real purpose of the short-term portfolio is to say to yourself every day, well, okay, so I'm at this point in my long-term portfolio, and if the market goes down, what's going to go down that will make me some money to offset the loss in my long-term portfolio? And that's what you always want to look at. And then you also have to think about, like, what positions do you have. In the income portfolio, we're very, very heavily Apple weighted, much more so than the long-term portfolio. So that's why also we added those Qs at the time, because we were a little bit concerned about Apple coming into earnings and that position. As it is, now we're concerned about the fact that we have these stupid short calls. But we're overcovered because in addition to this Apple spread, which is 70 bullish against 40 bearish, we have these apples too. We have another 30. So we actually have 100 long Apple positions. And this is that 2017 9120 spread. I keep basically pounding the table. I think every other day I tell people this is my favorite trade on the planet. So this spread, because this spread is still well, this says like $11, so it's still around $11, $12. Oh no, I'm sorry, that's what we bought it for. Yeah, here it's showing, yeah, it's still $12. It's still about the same. It's not moving. It's not doing anything. In fact, it's showing a teeny tiny gain here. It's a $30 spread. What other way would I want to get into Apple? It's at 102. It costs you $12 for the spread. That means you're paying $0. you're paying the exact cost of a $90 call. So instead of spending $90 to own Apple, I don't know why anybody would do this where they're, you give up their 2% dividend, and you instead of spending $90, you spend $12, and you have the exact. I'm sorry, instead of spending 102, you spend $12, and you own the 90 calls, and you make all the upside up to 120. The only thing you're doing is hedging your upside at 120. But you know what? 120 is a triple. You're getting back 3 times your money. You're getting back $30 off your $12 investment. That stuff's fantastic. So again, I love this trade. So we have 30 of those. We have 70 of these. These are older ones that are also aggressive, but these top out at 107, and they top out a year earlier. So we're getting there already. These guys, now since there's 40 of these and 30 of those, we can roll these all the way out to 2017 eventually. We're only at January 15 right now, so we can roll them and roll them and roll them. And if Apple ever has a pullback, then we keep this $40,000. If Apple ever has a serious pullback, then that $40,000 just drops into our wallets, or at the moment it's $50,000 negative. But instead of being a loss, that would suddenly turn into a gain of $40,000. So that in itself is a huge hedge that we're carrying against the bearish market. Of course, as we've been discussing, I'm kind of losing faith in Apple ever going down again. And we'll see, if we come into Christmas and everything is still hunky-dory, I might decide that we want to move that thing along or start paring it down. But, realize, of course, that this is a $90 call. We sold it for $10, and it's now $12.75, and it's still got plenty of premium. Actually, it doesn't have premium because Apple's at 102, so it barely has any premium now. But we sold it for 10. It's at 12.75. We're only down $2, $2.75. This position, we paid net. Jesus, we paid net $4 basically, $4.50, and it's a $20 spread. So we're going to make if we close at 107, we're going to make $15 on this one, and there's 70 of those, and we're going to lose at 107. We're going to lose $7 here. So it's still going to make 8 times 70. We're going to make 8 times 40 plus 15 times 30 to the left. Plus, we'll be ahead on the other one. So it's a stunning amount of money, and it's in no way is it reflected in the portfolio because the portfolio isn't that smart. You're not going to see these things because you have to understand the mechanics of the premium that you're selling and the time value of that premium and like I always say, I keep talking about this whenever we discuss positions and whenever we go to the portfolios, is it on track or is it not on track? And the key is that things got to be on track. If your position's on track, you have to know and say, look, I know I've got $100,000 coming to me in this position. So I don't give a crap what it says my balance is in the STP. As long as my Apple position's on track, I know there's another $100,000 coming down the pike. Just got to wait for it. So we manage it and we massage it and whatever. But that means also, though, that when these other guys go low, when Cliffs goes low, when CCJ goes low, when ABX goes low, I'm like, I got $100,000 to spend. As long as Apple's not going low, I take some of that theoretical profit, and I'm happy to put more money into like material stocks and cyclicals that aren't doing well at the moment. And what's going on in the indexes here? 102. Okay, I forgot I left a bet on. Let's see where we are. Nope, not there. Active trader. What I have? 5. Okay, so that's not so bad. So I have 5 short, TFs left over, which I really should have paid attention to. This is what happens when we went seminars. Like, I always have the worst habits, right? I'm supposed to be watching these things. I'm like totally ignoring it for the whole time we're talking. It's not bad though. Essentially the market's doing exactly what we thought it would do. It topped out with the EU close at 11:30, and it stayed up a little bit, but nothing major, and it just got weaker and weaker and weaker, and now it's sort of trailing off a bit. So I think I'd like to see 1100 get tested because I do think we'll hit that target. So I'm willing to risk my little profits to see what happens on that one. But that's where we are at the moment. So you know, I just think that, you know, look, the Europeans were very excited. They had their bounce. You know, we already had a huge bounce. They didn't have this bounce when we had it. They just finally woke up the last couple of days and said, hey, we're going to rally too. And so they rallied, but they're a little bit late, and they're buying our stuff, and they buy their stuff. So we'll see how that works out in the end. But somebody please tell me if this thing goes over 1103, because I don't want to lose money on it and feel like an idiot. So let's see. Would you, okay, so I'm sorry, back to finishing this other thing though. So if you only have, and again, it's not, I'm sorry, how did you put it? Let's see. So Craig said with less resources who have a single portfolio, it's not about resources. You just take, I find it easier because we have a lot of positions and I like to separate the portfolios. But if you have a regular portfolio, you've got 10 long positions and you're managing those, and you should, then it's the same concept that you should take of, you know, if you have $100,000 allocated to 10 long positions, then you should be taking about $20,000 and allocating it to a smaller portfolio, to another section, and that section has got to be for your hedges. And you got to always be looking for, like, what could I get that would offset these guys? So if you have a lot of real estate stocks, you might want to find a weak real estate stock and just short it. You know, that's valid too. You know, you want to kind of get in your sector, or you may want to short XR. What is it? XRT? No, whatever the real estate thing is, XRY thing. You know, you short the spider for that sector. You know, something like that. You just want to create a hedge. But what we, you know, so I'm using index hedges because that relates to most people. Most people are fairly diversified and they want to hedge the entire index. But if you're sector specific, then you short the ETF for your sector. And what you do is you roll it up. All right, so let's go. Now Steve says, how would you explain the short calls, paper loss, turn a profit? Would you explain how the short calls paper loss turns to a profit if the stock drops? How the short calls paper loss. Why am I having a brain trauma here? The paper loss of the short call turns into a profit if the stock drops. Okay, well I would think you know that, right? Well, using Apple, for example, we collected 40,000 bucks, selling 40 of these guys for 10 bucks, okay? At the moment, we have a paper loss because it's at 102. We have a paper loss of 275. So we're down, well, whatever the number is, but we're down $10,600. That's our paper loss. So what happens if the stock drops? Well, if the stock drops, the value of this call diminishes, right? And the closer you get to January, the less premium it's going to have and the faster it diminishes. Now, the reason we didn't get a good sale price on this is because we already rolled it from a bad call that we previously sold. You know, we sold something, I think they were the 87s or something. We only rolled them up like a little teeny bit. We sold the October 87s. And now we rolled into the January 90s for I think it was roughly the same amount of money. Like there was very little money in the roll. And but the point was we just wanted to bump it up a little bit because we do think Apple was going higher, but we also didn't want to spend any money ahead of earnings because just in case we were wrong, that would have been tragic. Now, we also, though, have the ability to sell puts. So we could sell some Apple puts. And let's say we sell, we already sold these for 10 bucks, okay? We haven't technically used it, but don't forget, these two things can't happen at the same time. Apple can't be below 87 and above 90 at the same time. One or the other will expire worthless. So here we sold $20,000 worth of puts, and we sold $40,000 worth of calls. One of these will go to zero. And in order for us to lose money, then we have to have a negative 60,000, and we have negative 50 now. But in order for us to lose money, we have to be negative 60,000 on one of them. So Apple would have to be up another, I don't know. I can't do the math. Is that 250? Up another 250. So Apple would have to be at 104.50 before we actually start losing money on the net of the spread. All right, so you understand? So this would become 60, and this would become 0 at some point. And so at that point, then we have a problem. But you know what? We only sold 20 puts, so we can always sell some more puts, get another $20,000, and now Apple would have to go up to 105, 106. And what happens when Apple's at 105, 106? When Apple's at 106, we get 100% of this money. And how much is that? That's going to be 20 times 70 is 140,000 bucks. How much is it currently showing? It's currently showing 80,000 bucks, let's say. So there's another $60,000 to be gained on this position alone, on this spread. Has another $60,000 to gain, and we're going to gain it if these calls end up costing us money. Now, if the calls don't end up costing us money, why would that be? That would be because Apple went down. Now, if Apple goes down and it goes below 90, even this can't get wiped out unless Apple is below 85.71. If Apple goes below 90 though in January, I still have a year for these to recover. These turn to zero, and then what happens? Well, then I got 40,000 bucks. I only spent 30,000 bucks for that spread. So I'm up $10,000 and I still have the spread for another year. There's so many ways to win on this position. You see, and of course we did 20 because you don't want to oversell Apple. I don't want to be stuck with much more than 2,000 shares of Apple is 200,000 bucks, right? Yeah. So I mean, at this price it's a little less. It's like 170, but whatever. So I don't really want to have much more than $170,000 worth of Apple in my portfolio. I mean, now, and again, this is all management because I've got a $500,000 cash portfolio. It's got $1 million in buying power. I don't really want Apple to be 20% of my portfolio, but I feel pretty freaking confident that that's not going to happen. And aside from feeling pretty confident that's not going to happen with 20 short puts, I also know that I'm going to gain $40,000 on the calls if I do get this assigned to me. So I'm getting another $40,000 discount, which is about another $20 off. So I'm technically going to net into Apple at like $67 a share if it goes down, because these guys will expire worthless. And I'll have to buy these, but I'll end up at $67 net on this one, or less, because it's already discounted. So, geez, how would I work that out? Okay, well, let's see. It's as if I sold these for $60 a pop, and so that's like taking 30 off this price. So it's here around $57. So if I get assigned these, I can't get assigned these unless these expire worthless. So if I get assigned these and these expire worthless, and I'm netting in at $57 a share, do I want to own 2,000 shares of Apple at $57 a share? You're damn right I do. In fact, I'll be pissed off if I only end up with 2,000 shares if I get them for $57 a share. I'll say, damn, why didn't I do 40? Why didn't I sell 40 puts? All right, so at that point, so when when you understand the math of that, that's when you can say, okay, so that's when you get comfortable with your position. That's when you don't worry about a drop. I don't worry about a rise, because I understand what I can do. I'm very happy to add. So having had that conversation, I'm happy to add 20 more short puts. All right, I probably won't need to, but if push comes to shove, the only reason I'd want to add 20 more short puts is because Apple went so far up that these guys start worrying me, and if these guys start worrying me, then these guys would not be worrying me at all because they're on the other end of the spectrum, and that means all I'm going to do is essentially replace these short puts with some more short puts that sell for $10+ again, and we'll drop, another $20,000 basically into the portfolio. And then worse comes to, and I've still got all my longs covering the upside, so I'm not worried about that either. So that's what, and this is, by the way, this is what you do, or you should be doing, like on every position. And this is what I do, except I'm doing it. I'm talking now instead of doing it in my head. But this is what I do whenever I give you guys an answer in chat. It's like I go through all the permutations and I try to come up with like the best overall sort of spread that'll cover the most contingencies. And then, of course, over time, that doesn't exempt us from like making adjustments over time. There's good and bad adjustments to make sometimes. Like I said, we just adjusted those short calls last week. But you manage the position and try to take advantage when something goes up or down on you. And oh, you sons of bitches! Nobody told me that the Russell went up, or maybe somebody didn't see it because this thing doesn't scroll. Damn it! Look at that. That just wiped out my nice game. I'm pissed. All right, anyhow. See, now I got to find out why it popped. So I'm not even going to worry about that right now. We'll get back to this thing. So it cost me $1,000 to tell you about this. And where was I? Oh, yeah. So you try to construct a position that's going to weather the storm in various directions, and much more so, of course, when it's a big position like Apple, because it's like, it's going 100,000 here, 50,000 there. You want to make sure you know what the hell is going on. But with every position, you should have that sort of general idea. And if you know you did that on all your positions, if you know you went through what happens if it goes down 20%, what happens if it goes down 40%, what happens if it goes up 20%, 40%, what if it's flat? If you know that you're comfortable with what you're going to do on every, on any big move in the market, whether it's flat or up or down 20% in the very least, if you're comfortable with that and what you're going to do next, then it's a good position. And then you also will be able to look at your portfolio and see these numbers that say you're down 10,000, down 40,000, and you'll be able to say, oh, no, I'm not. I'm not worried about that because it's freaking premium. We sell premium. We know what premium is. It's the stuff we sell to suckers. It's not the stuff that we react to and act like we're suddenly losing money when we're not. And now, of course, you need to keep plenty of cash on hand because your broker sure as hell thinks you're losing money because they structure their systems to make you panic. They want you to panic out of positions. They want you to constantly be buying and selling. They don't want you to sit on your positions like we do. It's death for the broker. They want fees. They want you to churn your account. So they love the violent swings. They love to show you that your balance in your portfolio zooms up and down all the time. But the reality is it's like your house, right? You buy a house, you've got your life savings put into your house, basically. You've got it leveraged to the hilt. You only put $50,000 down on a $500,000 house. Well, not these days probably, but in theory, so you're putting 10% down. And you're leveraged to the up and down of a $500,000 investment. If it drops 10%, it wipes out your entire investment. That's leverage trading. If it goes up 10%, you double your $50,000 investment. Now, unfortunately, as with options, though, there's a maintenance cost. If you want to keep rolling your investment, if you want to keep living in that house and keep your house investment, you've got to keep paying a premium every month. That premium is the interest the bank is charging you. All right, and the premium on a house, though, is kind of ridiculous because they're charging you 6%, or let's say 4% right now, but they're charging you 4% on $500,000 bucks. But you only made a $50,000 investment. That sucks. If you think about it, because that 6% is what, $30,000 a year. So you're paying 50% of your initial investment in premium every single year as you're making your payments. So that's just a premium that they're charging you. You're also, of course, paying and adding to your investment. You're reducing your leverage, but you're reducing your leverage over a very long period of time. So you seek to reduce your leverage so that you actually own the asset, but at the same time, you're paying this insane amount of premium for the asset while it's rolling along. That's exactly like a leveraged option trade. But people do this with a house all the time. They don't think twice about it. They're doing it their entire life savings. Except and all you're seeing here is what your house would look like if it was on paper. When you use options for leverage, this is what it would look like if you actually looked at your home value and your mortgage and such on a regular basis. It would gyrate and fluctuate just like this. Except with a house, not to freak out about the ups and downs in the market. You say, well, I've got a use for this thing. I want to be in this house. Therefore, I'm not worried about whether it's up or down 20%. And if you felt that way about your portfolio, you wouldn't worry about it so much. If you had a portfolio full of stocks that you intend to own for 20 years, you wouldn't freak out about whether it's up or down 20% in any given year. And you would instead make good, intelligent adjustments to improve your positions when the opportunities come. Just like with your house, you might add a bedroom or or do a deck or something like that. It's the same thing. There's certain times when it's right to make a bigger investment and do it. Sometimes it's the right time to refinance your investment and change it. All right? But it's all about whether you can learn to have a long-term view. And I'm telling you that all of you can do it because I know a lot of you guys, you look at this stuff and you say, I don't know how I can ever get my head around that kind of stuff. Your head is around that kind of stuff because you do it when you buy a house. You just got to learn it's not different. They're both leveraged investments that you make. And it works with housing because you've seen it work for your parents and your grandparents and everyone else. And we just went through a horrific crisis in housing, and we survived it, most of us. So those of us who were able to hold our houses, who were fortunate enough to have jobs, keep making those mortgage payments, ride the thing out, we rode out a 30 to 50% drop in the value of our homes. And what did we do? We kept rolling our position. We kept making our payments and paying the premium, and we rolled back in time until the price came back. So if you're all equity, then it's the same thing as holding a stock position until it comes back. And if you have options, if you're mostly just basically starting with a new house and you got whacked on the leverage, you were upside down. You know, if you bought that $500,000 house and went down to $300,000 in the crash, then you were negative 150 on your $50,000 investment. You were down 150%. That's wiped out. If that was a portfolio, you would have had a margin call. But since it was a house, you're able to roll your bad position by making those monthly payments. And every time you make a monthly payment, what are you doing? You're pushing back the day of reckoning at which you have to then sell your house. And by pushing back that day of reckoning far enough, 3 years, 5 years later, now you got your money back. Your investment came back. And if we're lucky, housing prices will go up again one day and you'll actually make money like you planned. Now, imagine if you had plenty of cash during the crash and you went out when houses were dirt cheap and you went buying. If only you had a short-term portfolio against your house, right? This is what I'm teaching you guys to do. And it's hard to teach because it's hard to get people to understand that long-term perspective. It's hard to get people to get in this mindset. And it's also hard to teach by example. It's really the kind of thing where it's like takes a couple of years of actually going through these things to understand, like, boom. And we get that all the time with our members, 2-3 years in, they suddenly go, oh my God, I get this now. Because you start seeing how much it improves your portfolio. You start seeing like, wow, these sons of bitch things are paying off. You know, it's amazing. You're like, oh, I remember when that thing sucked and now it's great. I remember when that one's terrible. I was going to give up on them and now it's one of my best decisions. Happens all the time. But it's never evident while you're in the middle of it. It only becomes evident as you go forward. All right. So moving on to more questions. Oh, Pat, thank you. I'm sorry. You know, the problem is this chat box doesn't scroll unless I scroll it. So we're kind of screwed there. So let's take a quick look at the Russell. 1105, I'm happy, though, because my basis is God knows what, but I'm happy to buy some more. I'm sorry, sell some more. And it won't let me. You bastard. So I was gonna like start adding to it, but it's oh, wait, here it comes. Come on, Phil. There it goes. Come on, one more. Let's go one more there. So what I'm doing is by doing this, I'm raising my basis, and by raising my basis by selling at higher strikes, that means I'm going to make more money if there's a move down. It also means I'm going to get my ass kicked if it moves up. But I see 1929 here. Hopefully 1930 won't break. I see 16.5. I think that might get a little rejection. And I see 39.50. So I see a bunch of places where we could get a rejection here. I also see a spike up. I don't know why it spiked up. If anyone knows, I'd appreciate knowing that. But I saw it spike up. So I don't mind, you know, take a little chance and sell a couple more and see what happens. So we will now, I'll leave it alone for a minute and see how it goes, and we'll talk. But I'll keep the screen up for now. Ideally, for my trading, I would like to have, I like to be 5 to 10 short, but really 5. I mean, 5 is my ideal where I'm comfortable with losing whatever. I could lose a couple of thousand if it's on 5. I'm willing to go to 10, and if I get a good price. So I'm getting a good price now, more than 550, but I'm not going to take this now because I just did 2. So if I'm going to do 3 more, I'm going to want to see something close to 106. And see how 107 was the top? So I'm just kind of keeping an eye on that to see where I can get it. But if I can get around 106, then it's worth adding 3 more. And Craig says, is Apple Pay good for Visa, MasterCard, or will it hurt me tomorrow? I just put up an article in chat earlier about Apple Pay, and I also was watching a little thing on Bloomberg. But actually, the article is more important. The article was saying Apple's getting like the swipe fees. I think that's usually revenue that MasterCard or Visa would capture, and they're obviously not capturing because no one's swiping a card, right? They're cooperating with Apple, but I think they're cooperating with Apple because Apple probably, you know, Apple is sitting on, I forget the number, like $200 billion of cash at this point. Is certainly saying to these guys, and you know, MasterCard and Visa don't have $200 billion of cash. Apple's saying, unless you want Apple to be a new payment company that competes with you guys, we're all going to play ball together. So that's nice, and that's how they did it. And believe me, the credit card companies didn't give up their little moat that easily. But you can't stop it. You got these iPhones in everybody's hands. People are running it. And again, a very important thing, you get fooled by market share. They've done many, many studies, and the bottom line is Apple people have money. Apple people are the top 10, 20% of the country. And not that nobody in the top 10 or 20% has Google phones, Android phones, but the reality is that the average person with an iPhone spends 10 times more money on their phone, like in the Apple Store and iTunes and things like that. They spend 10 times more money than people with Google phones. Now, of course, it's kind of obvious because people with Google phones are free, Android phones are free, and therefore you're going to skew towards people who want free phones, who have no money. So people with no money you've got that audience. The bottom 20% are, of course, not going to have an iPhone. They can't possibly afford it. The bottom 40% probably aren't going to get an iPhone. So it dilutes. So in other words, if you figure that the top 20% is 50-50 Apple and Android, the point is, though, that there's no dilution to that number. Apple has captured all the top-tier consumers, or half of the top-tier consumers. The Android may have captured them, but they've also captured so many people who have no money that it drags down the averages. But the point being, though, that Apple, although it's a narrow market share compared to Android, I think Apple's got maybe 20% of the total market. Compared to Android, the 20% they have is the 20% they want. There's still more. There's still another 20% to get, the top 40%. There's still another 20% of the people to get, but Apple just dominates in the upper quintile. And because they dominate that, those are the people who Visa and MasterCard care about. And it's going to be really, really hard for them to displace Apple. If Apple could have gone to any one of those companies and made an exclusive deal, like American Express or something like that, and it would have screwed these guys over. So step one, Apple's in there, and they've got wide acceptance, and they're going to be on every single terminal over the next year, and it's going to be just anywhere you go, you just use your card for a thing. And in fact, you'll see very quickly people are going to start complaining that they can't use their phone for a thing. It's like, why are you making me pull out my wallet? Why do I have to open my purse? What kind of crap is this? My kids are not going to shop anywhere if they can't use the phone, because that's how they're going to have their money. They're going to go to the mall, and they're going to go to the stores and have an Apple Pay. If the store doesn't have an Apple Pay, they can't buy anything. They don't use cash. That's the way it's going to work. So as Apple becomes more and more important and starts taking this over, it's going to screw Visa and MasterCard over, and Apple's going to be able to just arm them for better rates, more fees, so on and so forth. And they can still turn around and just screw them over and become a credit card company down the road also. But why would they? As long as they can get all the fees from everybody, it's less headache than competing. And Apple, and frankly, Visa and MasterCard don't have the margins Apple likes. Apple likes better margins than that. The margins they get by these fees are 100%. They don't do anything. Apple's not doing anything. Every cent they get, like iTunes. Everything they get is from somebody else's work and somebody else's labor, and all they're doing is facilitating a transaction and collecting fees. So they love it. That's exactly in their wheelhouse. I think the amount of money is going to be underestimated. And you're talking about worldwide, you're talking about trillions of dollars in sales. They don't need to capture a lot of that to make some really nice money. In fact, if you think about it, one of the trillions of dollars in sales, 1% is $30 billion. And if Apple gets 10% of the 1%, credit card, so I figure Visa and MasterCard get 2% of $3 trillion. So that's like $60 billion in fees. That's about right. But in fact, really quickly, I say these things and I got to check it because I don't want to be wrong about it. But let me just find where the hell is YHOO? Well, there it is. So let's go to Visa and see how much money they do get. Income statement for Visa. So they're getting $11 billion. MasterCard gets what? Oh, that's so MasterCard's getting 8. That's $20 billion, and AXP is getting See that? That's why you want to cater to the top tier. American Express gets $34 billion. So I was right. So in total, you're around $60 billion. Then there's Discover and blah blah blah. So in total, you're looking at roughly $60 billion in fees goes down to the credit card companies. So that's their 2% cut that they get for the at every checkout. Apple then is probably going to get 10% of that 2%, maybe a little bit more. And over the long run, though, what is going to happen as Apple becomes more powerful and is a primary means of transaction? First of all, they're going to capture more of the high-end transactions. So even though these guys think they're going to get 10% and 2%, they might get more because their transactions will be the higher-end transactions. Also, though, what's going to happen is over time, I'm sure Apple will make little inroads in other places. But even so, you're talking about $6 billion, which is free money, dropping to Apple's bottom line in the course of a year. I would say first year, $3 billion, but I guarantee it's going to go to 6, and they'll find a way to make it 9. They'll find a way to make it 12 over the next decade. It'll start to become quite a big source of income for them. That's without doing anything drastic. That's just sort of ingraining themselves in this process. So will it hurt Visa and MasterCard in the long run? I think, yeah. I mean, of course it's going to hurt them because they're giving up some portion of their growth, but they're only going to give up about 10%, and it hurts them a lot less than if they try to go to war with Apple, because that can become devastating. That's like when they decided not to play ball with Discover, and then Discover became its own card, and so on and so forth. Instead of being a brand of Visa or MasterCard, the people at Discover ended up starting their own company. And what are they? DFS? Discover? Discovery Communication, no, these guys, yeah, DFS. Oh, can't believe I know these things in my head. It's ridiculous. Discover, $10 billion there. Okay. So, so how much did that hurt them? That hurt them, but obviously Visa and MasterCard have both done very, very well despite that little $10 billion ding that was taken by them. And then don't forget, we're only talking about the majors. We're not talking about the gas credit cards, the department store credit cards, blah. It's a big industry, man. And Apple's going to hit them all. You're going to be able to use your iPhone in Bloomingdale's, or Bloomingdale's is going to be in big trouble. And Mike says that we'll go to zero because we'll be using Bitcoin. Yeah, but how are you going to use your Bitcoins with your iPhone? It doesn't matter. It's like, I have my two girls. I was talking about this in chat. My two girls are 12 and 14. So from them, I observe maybe 20 or 30 close friends of theirs that I see on a regular basis. I watch them, I observe them in their natural habitats. I'm always happy because I'm fascinated. I'm happy to take my kids to the mall, and I'm happy to go to a dinner with the kids and be the parent who's going to take everyone out for dinner and stuff, because I love to watch these kids. I love to observe them and see what they're doing and get their habits and see where they're at and see what kind of things they like to buy and what they talk about. To me, that's like marketing research. I love it. So I sit there. One thing I know for sure, because I've been watching it lately since Apple Pay started, is that these girls walk around, they've got a phone in a lock grip in their hands, and you guys see this in the malls too. All these kids, all these teenagers, that phone is there's not even a reason for them to have a purse or a spot in their purse for the phone. It's in their hand all the time. That's like part of their body. If they could just have it imprinted on their hand, they would probably, because they never want it out their hands. And if they have to charge their phone, this is the funniest thing, and they have to charge their phone, they can't let go of the phone. They just follow the phone to where the power is and sit there until it's charged. So this is their wallet. I mean, if you tell these kids that you could either use your phone or you can get some other thing like a card and a wallet and cash and coins and blah, they're like, why would I do that when I've got my phone in my hand right now? So it's only going to be about 2 years before the cycle goes and all the phones have some things. Every Apple phone will have a something, and so any kid who can afford it, which is, and again, all Apple cares about are the kids who can afford it. They don't care about the kids who can't afford it. They're not spending any money. Okay, I live in a normal town, like where people have normal jobs and normal salaries. I live in like a rich enclave, and although I live in Jersey, so we're generally rich in the first place, but for my area. So I live in a normal town, and I've got plenty of my friends are like regular working people with jobs and regular kids and stuff like that. Those people don't give their kids, when my kids go to the mall, I just hand them $20. My daughter's like, I'm going to the mall. I'm like, I know why she's telling me, because she's not coming to give me a kiss, she's coming in for $20. Not everyone's kid gets $20 to go to the mall. Apple wants my kids. They want the kids who have $20 to spend whenever they go to the mall. They want the kids who are going to make those purchases. And you think about millions of kids with $20. That's 20 million here on 20 million on a Saturday, 20 million on a, 1 million kids would be 20 million bucks. So you talk about 10 million kids. You talk about 200 million on Saturday, 200 million on Sunday. All boom through their phones all of a sudden. And that's the kind of money these guys are going to pick up. And those kids are all going to grow up, and they're going to be, well, look, you don't write checks, right? None of you guys write checks, occasionally. But my mom used to go around with a checkbook, right? She used to go around with she had a checkbook, and whenever she bought something, she'd be sitting there with her check. The credit card companies put checks out of business. Well, this is going to put credit cards out of business. One way or another, you're not going to, as far as using a credit card, the concept of a credit card company, they've got to reinvent themselves. They've got to stay on top of this, because a credit card company is just a concept now. So it's going to be very, very big changes, but I'm telling you that we're one generation away from people who are going to be like, what do you, we're going to pull out a credit card and we're going to look like old folks, the same way as if my mom pulls out a checkbook and starts writing a check in the supermarket. It's like, what the hell are you doing? It's like, haven't you ever heard of a credit card? And my kids are going to be like, what are you doing with that thing? It's like, use your phone. So I think that's going to happen extremely fast, extremely quickly, because it makes sense. I can't wait to start using my cards too. All right, your mom says the fact that the house has a use value rather than C. Yep, that's true. Okay, so that's economics. Where are we? 105.50. Darn it. Oh, I cannot believe that. So pissed. Anyway, this is why we watch the future. So while we were doing this, what did I lose, like $2,800 while I was doing the seminar? That's so annoying. So I was up nicely, and I should have taken the money and run. In fact, I did. In fact, in chat, what's the last thing I said to you guys? I shouldn't even look, because it's going to piss me off. The last thing I said was put a stop at 10,250. Not 10, whatever the hell it was. I know there was a number I was looking at. What? Wow. You hear that? That was terrible. Annoying advertising. Where were we? I think it was right before this webinar started. Ah, there you go. TF coming down nicely, now 102, that makes 102.50 the stop. See, I just need to follow my own advice. But then I got busy. Now, oh good, okay, so now I get to, come on. Let's put one in there, see if it fills. Still want 3 more, there's 1. Now I'd like to get 1 over here, but I'm not going to put a thing in. Oh, and by the way, when I do this, so I just did, what did we do, 105.8? So I know I just did 105.8. Now, if we go to 103.5, 105.3. If we go to 105.3, I'm going to take that one right back off the table, because you know what? That's $50. So if I add one here, and in 5 seconds later it makes $50, I'll take it off, because if it bounces back, I'm going to add another one. And if it doesn't bounce back up, and it keeps going down, well, then all my stuff went down. I'm going to be happy anyway. You got to take advantage of these little gains when you make them. If you're scaling in and out of these things, you've got to learn to take advantage of it. It's very important. Okay, 106, perfect. Ah, come on. And we're still not at 1930 there, so I'm happy about that. We're still skirting 16.5, and we're still not at 34. We're still not at 39.50 here. All right, and general as a rule of thumb, if I make $50, I like to take my $50. So if we get back to 105 now, I'll take one of these off the table. If I don't get my $50, I'm gonna make my 10th position. but I don't know of anything significant. Oh, look at that. So if that fails, which it's not, three, two, one, and go. Boy, am I good. All right, so that failed. So now I'm ready to reload again, right? So I just made on that one 50, 60 bucks. I'm ready to reload again, but here we come down, and now it's down here, so I'm going to take another one off. All right, and so why am I doing that? Because we started off with 5. Remember, we had 5, and it was a bit higher than we wanted to be. I think we were down around 10. I think our average was pretty much 105. And as it goes over, I'm adding a few, and that's bringing my basis higher, so I make more money off a short run. So, my premise is, of course, that this spike over 105 isn't going to last, and that everybody's going to sell off a bit into the close. Could be wrong, but we'll see what happens. I won't do this overnight, though. This is not the kind of thing I would have confidence on overnight. If we're going to break, because if we're going to hold these levels, what are our bounce levels? Our bounce levels are, dun, 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 dun. Fortunately, we have this great website that tells this stuff in the Morning Post. All right. We were looking for, well, what do we have? We have Dow 16.5, so we're just above the week here. We have S&P is over 19, whatever, S&P 1934. So the S&P went flying through this today. Okay, yesterday it finished right at that line and flying through that. S&P is like way over here, super strong, let's call that. The NASDAQ also had a big day, and NASDAQ is now 4,400, so also flying through there. So super strong NASDAQ, super strong S&P. And why is that, though? Partially because Apple's up 2.5%. And Apple is 20% of the NASDAQ. So 0.5% of the NASDAQ. Let's do this. This is stuff, I mean, this is stuff I'd like you to be aware of at a regular time. So if Apple is 20% of the NASDAQ and it's up 2.5%, that means the entire NASDAQ is up 0.5% because of Apple, and 0.5% of 4,360 times 0.005 is 21 points. So 21 of the NASDAQ points are because of Apple. So what's Apple at? Apple is at, I'm sorry, what's the NASDAQ at? The NASDAQ is 4,400. So half of the move to 4,400 is because of Apple all by itself. All right, so that's things you take into account. And then you assume that if that's the case here, we have super strong NASDAQ, then I assume the super strong S&P is also being affected by NASDAQ. NASDAQ is God knows what percent of the S&P, but it also is responsible for some of that move. So it's the biggest component of the S&P is Apple. Now, NYSE, so that means that the Dow, the reason the Dow isn't super strong is because it doesn't have Apple in it. Now, let's see what the NYSE says. The NYSE also, it has Apple, but it's a smaller percentage of it because it's such a wide index. So the NYSE is at 10,470. All right, so it's close to strong, but not strong. And the Russell doesn't have Apple, and the Russell is right here at weak. So our two non-Apple positions are still generally weak, our non-Apple indexes. Our Apple indexes are super strong, and just barely over weak. I'm sorry, what's that NYSE number? 10,470. No, actually it's near strong. So super strong, and almost strong are what we have. Now, despite that, you still have to respect the move. You know, when you are adding, we're adding we're adding a green here, two greens, we're adding that green, and we're adding that green. That's, I forget now, 1, 2, 3, 4. So we're adding 4 greens in one day. That's a lot. Okay, that's half of our reds have turned green, or more than half of our reds have turned green. So you have to respect that move because we're on track for everybody to be over the strong bounces by tomorrow. And if everyone's over the strong bounces by tomorrow, we have to get bullish. All right, we don't have a choice. We have to get bullish if everything's going over the strong bounces. So, so you can't just keep being bearish. I'm just trying it because we may get rejected here, but maybe we won't. And see what's happening now? We're hitting 1602. I'm watching. He's going up a little bit. He's up a little bit, but none of these guys are up anywhere where I don't want to short again. So I'm going to go back. Remember how we sold these before? Got 2 more to sell. Nope, missed it. So you see what I tried to do? I was holding until I was hoping it might go up another one, so I get a sell, and I held it, then it fell down too fast for me to get the fill. So I keep my pointer in the box, like here, and I'm hoping I gain another box. Oh, but you see what happened? So my instinct is right. I was trying to sell here and hoping it would pop back down like that. So let's see what happens now. Now notice you have 19 here, so the pressure is down. If you have more on one side than the other, that's where the pressure is. So you have 27 down, 18 up, the pressure is down. 18 down, 16 up is neutral, and it went up. Now you have 25 and 18, so your pressure is down. But if you start seeing this start eroding, see that? Then you start seeing those eroding, then you see what happens. Now I'm here where I wanted to sell. Doesn't change my mind. I'm still following through my program. I've got 1 more to sell, and my 1 more to sell would be very close to 1106.9. So I'd say here, I'd be willing to sell here, but of course if it gets there, then that means I'm in trouble, because that means all the rest of my positions are starting to lose some serious money. But I'm still not seeing that 1930. I'm still not seeing this guy get 39.50. He's still like flatlining at 16.5. So I'm just hoping that this is going to be the end of it. Oh, geez, now I'm screwed. All right, that's not good. So you're seeing a new high? That's not a good sign. Oh, and he just hit 1930. Shit. So if he hits 39.50, I got to really start thinking about pulling the plug on that one, because that's not good. They don't know what's driving this? Is anybody watching the news or anything? Okay, so anyway, let's get back to YHOO. Do you think that, could there be antitrust calls? That's a good question. Against Apple for attempting to control too many services? I don't know, because I mean, you know, Microsoft controls the entire planet, so it's kind of hard to say that Apple will control. Apple can always point to Microsoft and go, what? I mean, I'm sure if you're asking me this question, the chance of you not having a Microsoft product that you're asking me on is only about 10%. I don't think that Apple's going to be, the diversified concept. Look, it's a cornerstone of American life, right? I mean, look at GE, look at IBM, people, look at AT&T, people into all sorts of things. And also Apple does a really good job of portraying themselves as the good guys, right? They're the beneficial guys. They're the ones who are trying to make our lives better. That's all they try to do. They're trying to help you. They want to take you into the future. It's a fantastic campaign. I mean, they really have everybody convinced. So, and look at Google. I mean, especially Google, they want you to have their car. They want you to have their phone, their car, their search engine. Actually, the most insidious thing in the world is what Google's doing with search, because by taking over search and having a 90% market share of search, it means that essentially everything you know is what Google wants you to know. And everything you buy, and when you do a search and you say, what's the best vacation spot in Vermont? It's whatever Google tells you it is. I mean, I understand, obviously you're going to a website and there's websites with different opinions and stuff, but Google's ranking those websites. They can exercise incredible control over the information you're getting. I mean, that's the scariest monopoly in America. When you control information, I mean, it's funny because this is how it always starts, because, you look at the company there and you're like, oh, well, Sergey and Larry, they're great guys, and this guy's great, and the other guy is fine, the CEO, whatever his name is, Schmidt. They're all nice guys, and they're all doing all this great stuff, and blah, blah, blah. What about 20 years from now, though, when none of those guys are around, and Google still controls all the information? Who takes over? Well, what if right now Dick Cheney is attempting to take over Google and is going to start controlling it? Because if Dick Cheney takes over Google, or Karl Rove, or whoever or Prius, what's his name? Plebis, the GOP guy. So let's say Rand's Plebis. So let's say Rand's Plebis. Sounds like a cartoon name. So let's say Rand Plebis takes over Google, or he has his cronies come in, or the Koch brothers take over Google over the next 20 years. And then they control everything, and they control all the information, and they're going to tell you which politicians are good and which ones suck, and they're going to tell you what's right and wrong about what the president's policies are. Nobody should have that kind of power. Nobody, nobody, nobody. It's not a democracy when anybody can do something like that. It means we have bullshit antitrust regulations. We don't do enough to stop this sort of thing. And one day it'll be turned against us. And the scary thing with Google is it's the whole world. It's not just America. It's everywhere. They control the whole world. And what do? We treat countries that ban Google or try to stop them from coming in, we treat them like they're the bad guys. Like, oh, they're censoring, or oh, they've got an antitrust thing against Google. What's their problem? No, they don't have a problem. A lot of countries legitimately think it's a terrible thing. Countries that aren't influenced by Google think that Google is a terrible thing. They think that there's something very, very bad about one company having control of all your information. Now, you might say that China feels that way because they want to control all your information, and it's true. I mean, obviously, everybody, if you can control information, people want to control it. If you can control the air, people want to control that too. I mean, people want to control things that can be controlled. So if you want to worry about something, don't worry about that. I mean, hopefully, people like Apple and IBM, with Watson and Siri and whatever, will eventually come to be valid valid competitors to Google as far as search and stuff like that. Because you can't have one company be in charge of all your information. It's going to get abused. Like I said, even these guys with the best intentions in the world, if your political party, if your group, if your oligarchy of corporate people, if you can win by taking control of the information, and you make a 20-year plan to take control of the information, and taking control of the information means buying up stock in Google, getting on the board of Google, getting your people into Google to work there, whatever, somebody's going to start doing it. That's just the way the world works. It's always worked that way. And now the thing, so if one company controls all the information, it makes it easier for people to do that. That used to be our logic in not allowing this sort of stuff. This is why we didn't allow monopolies. This is why we don't allow one company to have everything. This is why information theoretically was supposed to be free. It's not free if you have to pay Google to get ranked. That's not free information. That's information for the rich. That means if you're rich, you get seen. If you're not rich, you don't get seen. And that's, it's really crazy. But anyway, so that's a side issue. Meanwhile, I won't be rich if this keeps up, so let's hope it calms down at some point. But this is what I wanted. I mean, I got to tell you, frankly, I wanted to have a big position short on the Russell at around 11:05. I'm at 11:07, so I'm not happy it shot over my mark, but I still think that this pattern, see here, I think we're going to complete an M and come back down. All right, and I'm going to be wrong. If we're up here, it means I blew it. And now what's it going to cost me? Well, I know how much it's going to cost me. We're at 106 now. I'm down $2,000 bucks, so let's say 3 more is $3,000 bucks. I'll be down $5,000 bucks at 110. Don't want to be down $5,000 bucks, so I'm going to say I'll probably pull the plug at 750. It's already been to 750 though, so I have to see a new high. So I'm actually going to be down I'll be down at least another $1,000 bucks before I pull the plug on this. But I already know that. That's my bet. I'm going to be really pissed off too if that happens. Especially if I was up to like $2,000 bucks earlier, so it'll be kind of annoying. But I still think premise-wise, we're not holding 1930 here, we're not holding 3950 here, and 16.5, obviously the Dow is never impressive because any component can make it go either which way. So we shall see what happens. What else is going on in the charts? The dollar has weakened. See, that's another thing though. Look at the dollar. The dollar's from 85.50 down to 84 or 85, let's say. That's 50. That's 0.5%. So the dollar has goosed the index to 0.5%. Now I'm starting to feel a little more confident about my bet because this guy, bastard, 107.70. So This guy is over my line, but he's over by the amount the dollar went down. So had the dollar not gone down, there's a very good chance that this wouldn't have happened. So now I have to start thinking, well, do I think the dollar is going to really fall below 85? And I don't, because we know why the dollar's up. The dollar's up because of, the dollar was up because of the euro, and the euro has very good reasons to be weak because they're doing the stimulus thing again. Gold isn't buying that the dollar is going to stay weak because gold's still over 250. If the dollar was really going to get weak, gold would be going higher than this. It's not. Silver also not really doing much. It's at 1753 though. Oil. Oh, look at that. 82. That must be old oil. What are we up to now? We're up to Z, aren't we? Z4. What? Oh, that's old. Oh, that's interesting. CLZ4. So that is a new contract. So they've rolled it over apparently. What? Wait, CLZ4, 8202, 8204. I got to assume that's the same contract. So it seems to me that we're at, well, we can check it over here actually. If you want to see all the contracts, you go to products and you put in CL over here. And there you go. Yeah, so the current contract is CLZ4. So you can always look at your other contracts if you want to by doing that. So Z4 is the current December one, and the other one's gone. I guess it stops trading today, or probably stopped trading already. No, 2:30 we stopped trading. Anyway, so oil, 82 bucks. That's incredibly weak and sad. Silver, natural gas, even weaker than it started the day. Gasoline still in the doldrums. Look at that, 220. Poor thing. Now we have our inventories tomorrow for oil and gasoline, so we'll get some kind of handle on the story. Apple's down a teeny bit, so around that 102 spot. So everything's sort of like okay. You know, there's nothing particularly weak here, but like I said, I think the dollar is really what gave us this little pop, and since that gave us a pop, I'm sort of a little less inclined to get out of it at the moment. See what happens. But I'm also not inclined to add to it. I think I'll end up taking a loss in the end. Let's see. But if I was starting at this point, I certainly do favor this. I would do overnight because I think that's going to be a tough line to break, and I would certainly go like one short here and one short at 110 and one short at 115 and one short at 1, or maybe a couple at 120 if it gets there. But I would plan on it going to 115 and start shorting right here. So I think that's probably a pretty good spot. It's going to at some point just pull back and test 1100 again. Let's see. Okay, so we got the 215. That's true too. We also have the usual 215 to 230 sort of nonsense going on. Up there's 1930. On China, U.S. opinion differences on Google. It's much like the opinion differences between China and the U.S. economy, but usually completely trustworthy. Okay. That's a statement, yo mama, but okay. What level on Texan or listen to sell calls on the butterfly? Oh, Texan. Forgot about that. All right, that's a good one. Trade. Active trader. How come every time I look here, it's not as bad as it is on there? So let's see where TXN is. Oh, wow. At this point, that's a good question. In the butterfly, I mean, look, we're not in the business of taking risk in the butterfly portfolio. We're in the business of selling premium. So now that Texas Instruments has flown back to where we're comfortable, we absolutely want to take advantage of this move and sell some premium. So good call. It's exactly what we wanted. You know, we thought it was just kind of crazy low. We had confidence in earnings. I don't know if we discussed it last week, but I know we discussed it at right before the earnings took play. And let's see where we are. Oh, look at that. Back. See, I love this portfolio. Back to 19.5. So yeah, we're not. You know, we don't want to take risks. That's not the point. We took a risk because it was just so stupidly low. But we already sold the 45 puts, and we got 330 for those. You know, they're way out in January, but let's see what we can do now. Let's see if we can pick up $1.50 or so on something else. So TXN. Now January, it's at 46. So we think, you know, we think this is the right price for them. So yeah, that's sad. We only get $1.39 or $1.35 for those 47 calls. Now, let's not forget we sold the 45 calls. Is that the right one? I'm sorry, puts. We sold the 45 puts for 330. And this is one of the key things in the butterflies. You always got to remember that. Same thing we were talking about with Apple. They can't both expire. So in other words, if we sell the 45 calls for $250, all right? We sell those 45 calls for $250. Now we've collected $330 for the puts and $250 for the calls. That's like $6. So it would have to. So our saves zone is anywhere from $51 down to $39. We make money because we collected $6 for those puts and calls. And the closer it is to 45, the more money we make, up to a total of we can make $6. If it hits right at 45, they both expire worthless. So that is what we ideally like to do. Now, to some extent, we may want to use our discretion as far as saying, well, you know, we kind of feel like Texans are better than that, and then 45 is unlikely, and maybe we should just sell the 47s, and that's all nice, but then you know, then we don't have much downside protection and blah, blah, blah. So I think on the whole, I'm a little more comfortable selling the 46s. So what do? You know, so you go back and forth on something. You say, well, what's in between that? The 46s are between that. And so we collect $2 for the 46s. Now we have a zone between 45 and 46 where they both expire worthless. Most likely it'll be up, but since we're collecting $2 for the 46s and we collected $3 for the 45 puts, that means that, and by the way, remember why we sold those January puts? We sold them because the VIX was very high, and we got a great premium because Texan was going down and the VIX was high. That was the perfect time to sell them. We sold them. See on 10/16. Let's see where they were on 10/16. Look at that, 13, 14. So roughly 13, 14, 15, 16. So right about here in this spot last week, we said, you know what, we better sell these puts while the selling's good. So rather than sell November puts, we sold the January puts because they had more premium. So the VIX was up around like 20 or something. I mean, the VIX had to be in the 20s then. Now it's dipped back down to 16. So we got a really nice price, a crazy price, in fact, if you look at it now, of this is why we went naked. We got $3.30 for selling the 45 puts. Shoot. And you know, granted, they were at 42 at the time. Or I guess they must have been at 43 if we did it. So at the time we sold it, must have been right about here at 43. So they're at 43 at the time. We didn't get a huge premium still because Texan just doesn't have a good premium. But the point being that we had faith in the price of Texan. We knew what it was worth. And we didn't, you know, and we talk about that a lot. This is something constantly comes up in chat. We talk about it all the time. You got to know what your stock is worth. And if you don't understand a stock, if you don't have an idea of what it does for a living and how much it generates in income and what it makes it in good times and bad times and so on and so forth, if you don't understand that about your stock, then you don't know what it's worth, and how the hell can you make intelligent decisions? The same thing, Liz, goes back to the house again, right? When you buy a house, well, now obviously not everybody does know what a house is worth because they buy at the top of the market like idiots. But if you're like me, when you buy a house, you don't buy a house unless they're cheap. And when they go on sale, you come in and buy them. Like I bought my house for $400,000 in 1998 when the market took a little downturn. That was when I finally decided I was going to put my money down on the house. When it was at when somebody offered me $950,000 for it in 2004 or something like that, I told my wife, I'm like, we got to sell this thing. I'm like, you don't understand how much money that is. I'm like, I said, do you understand that we'll be able to come back in 2 years and buy the house again for less money? She was like, there's no way she was going for that. But that's, that's how I look at the house. I know what it's worth because there's a certain amount the land is worth. There's a certain amount it costs to build the house. There are facts that underlie the value of my home. Not about it's got a nice view, it's got this. Like, no, this is what my house is worth. And that's why when the housing market crashed, it was time to buy. Because when you can't, when the cost of building a house exceeds the cost of buying the house, then the house is a good deal. It's very simple. And we have the same thing when I talk about the miners, when we talk about like ABX and stuff like that. The cost of mining, the gold that's in the ground that ABX owns is worth more than the company by miles. Now, granted, at the moment, it's not worth it for them to pull it out of the ground because no one's offering a lot of money. But down the road, if gold ever becomes valuable again, they're sitting on a fortune. You have to understand the business and what it's worth. So we know, at Texas Instruments, we know how much chips they sell. We know who they sell chips to. We understand their business. We understand long-term, short-term, so on and so forth, where they can fluctuate. And so when they get panic sold off to 41, that's way too low. When they go up to 49, that's way too high. So when it's up here, we're more aggressive selling calls. And when it's down here, we're more aggressive selling puts. And that's what we did. Nice aggressive call sale. Made a lot of money. All right, so now, and long story short, I like 46. I don't know that they'll jump above the 47 line. And even if they do, I don't care because we sold these for 330. And if we sell these for 250, the 46 calls for 250 or $2, whatever the hell it was, we sell those calls. Now we've got so much money that unless it goes up over 51, we're going to make our money. And all I'm trying to do on Butterfly Portfolio is make a little bit of money every month. I don't want to get rich. I don't. I just want to make my money. I want to make my 20% a year. That's all I want to do. I want to make my 20%. I want to make a few $1,000s a month. And I do that by selling a lot of premium whenever I can. All right, so officially in the Butterfly Portfolio, we're selling those 46 calls to match the 45 puts. And thanks for bringing up, Pat. That's very important stuff. And I really appreciate when you guys find those things in chat because, I can't watch everything all the time. There's too many positions. So remind me that is super helpful. And Steve says, IBM is the company, has been heavily buying its own stock, paying dividends. What's your take on IBM? Look, my take on IBM, I don't care if they reduce their stock purchasing or not. IBM knows their stock is cheap. They're not doing the wrong thing. Their stock is too cheap. They are transitioning their business. They just took a huge write-off. That was the only reason that they disappointed in their earnings was because they got rid of a division they're no longer interested in. They paid somebody $1.5 billion to take it off their hands. So, and I said the other day, I'm like, why? How come they didn't call me? I would have let them pay me $1.2 billion. And I would have taken the division off their hands. It's just completely insane. But that's I'm sure there are other deals involved and other concessions that probably aren't obvious. But the bottom line is they had a losing division. They wanted to get rid of it. They took a $4 billion write-off, including the cash they paid to get rid of it. And that was the entirety of their loss. That was $4 a share of a loss this quarter. Had they not done that, they would have made $4 more a share. So they have 1 billion shares. There's nothing wrong with their business. Now their business is they're going to stop losing that money in the future. They don't have to deal with all those people, all the salaries. They don't have to deal with the energy and time it takes the CEO to worry about the stupid losing division. And they're free to start up another thing that's going to make them some money. So I think that's 100% the right thing that they did. But they're focused on, IBM has a long-term view. Analysts don't have a long-term view. Investors don't have a long-term view. Even investors, traders absolutely don't have a long-term view. Investors don't even have an actual long-term view. Investors think they have a long-term view if they're like buying something for a year. That's not a long-term view. IBM is making a plan for where they're going to be 10 years from now and 20 years from now. They've got plans. And that didn't fit in with their plan. So it's like a tree in the garden, or so a bush in the garden, or something like that. They trim off a branch. It wasn't going the way they wanted, so they cut the branch. And, you could sit there and go, oh, my God, why would you cut off a branch? Oh, the devastation, that catastrophe, it took all these years to grow it and blah, blah, blah. And they're like, it just wasn't fitting in the big picture. That's a perfectly valid reason to cut something. it didn't fit their big picture anymore. Even though they started the division, even though they built it, even though they put time and effort into it, it just wasn't going the way they wanted it to. So let's move on. All right, so I like IBM. We talked about the very, very important disclaimer to this trade, though, is because with IBM at 162, you can sell these puts, the 2017 120 puts. They're selling for $7. That nets you into IBM for 113. It's at 162 now. All right, and if you sell them, so let's say I sell 10 of these for $7. Okay, if you sell 10 of them in Thinkorswim, you collect $7,000, and it costs you $7,000 of buying power. Okay, so it's 100% return on your margin in 2 years for selling that position. Now, there's no saying that IBM won't go down to 150 or 140. And let's say IBM goes down to 140. That's $40, okay? What's going to happen? Then these puts will become whatever the 160 puts are. They'll go to $20. You'll still be fine because you're at net 113 and the stock's at 140. I'm sorry, 120. So the stock's at 120 and you're at net 113. It still won't be a bad thing. But if you panic out then, and if you're, so in other words, if you are the kind of, if what's going to happen to you when this stock shows that you're down 200% on the puts, and your margin is going to jump up, okay, let me show you something. If you assume the margin would be how do I explain this? Basically what you can do is you can take the margin at the spot it would be, hang on. You put in the sale price that you sold it for at the place where it would drop, all right? You follow that? That might be complicated. But what I'm saying is, in other words, I'm taking the 160s because if IBM drops $40, then I assume that the 120s will go to the price of the 160s, $40 difference, right? But when I want to look at the margin effect on that, I didn't sell the 160s for $21. I would have sold the 160s for $7. That's the price I sold those 120s for. So now I look at it, and now it's going to tell me it hurts me by $14,000. My buying power would fall $14,000. Hey, that's not so bad, right? I can deal with that. IBM, because it's not a generally volatile stock in the long term, the premiums aren't as bad. They're kind of low, these premiums. So it lets me know that the worst thing that's going to happen if IBM drops $40, even though I'm going to be, on paper, losing 200%, my margin's not going to be killing me, and I won't really be forced to sell. That is, of course, assuming you can deal with that kind of margin loss and so on and so forth. So the $14,000 margin is not so terrible. Even if I only sold them for $7,200, the margin is not so terrible. But by the way, that also means that if you want to be aggressive and you sell these suckers for $21, now let's go back to 21. So we sell those for $21.20. Look at that, you get $21,000 on $14,000 in margin. That's an aggressive way to go with IBM. But what I'm saying is that IBM sure as hell is worth more than 120. I don't care if half the company blows up, they're going to be worth 120. So I feel like that's free money to me. So if you have the margin laying around, and basically you're collecting $7,000 in cash for $7,000 in margin, you're trading cash for margin. If you have the margin laying around and you're interested in IBM, it's a nice way to make a few bucks. You are committing, though, don't get mistaken, you're committing to owning 1,000 shares. If you do 10, you're committing to owning 1,000 shares at $120 a share. It's a $120,000 commitment to make your $7,000, but the margin requirement for the commitment is not that high. All right, so it's all about, this is for people with a larger portfolio. But of course, if you don't have a large portfolio, why are you playing with IBM anyway? You shouldn't be trading any $100 stock if you don't have hundreds of thousands of dollars to spend. You know what I mean? Because your portfolio allocations shouldn't be large enough to support it. But if you have $1 million worth of a margin, $500,000 cash and $1 million in margin, this is the kind of trade that you might want to consider because $7,000 is nice to have. It uses very little of your margin. And worst case scenario, you end up owning $120,000 worth of IBM or $113,000 worth of IBM, 1,000 shares. So it's like, yeah, I would like 10% of my portfolio to be IBM if they're going to give it to me for $113. So in my mindset for that, I just take it, put it in a portfolio, stick it away, and most likely I'm going to never think about it again. It's just going to be like a little diminishing thing that's going to fall over time. You know, it'll say I owe $7,000, it'll say I owe $6,000, I owe $5,000. As the puts drop in price, it'll just keep giving me a lower reading until it either expires worthless or I get bored and buy it back. That's what we use those things for. So how IBM goes, and that Watson thing, yes, somebody makes a point there, that Watson thing, when it kicks off, is going to be beyond gigantic. So frankly, I would be probably more aggressive, but at the moment, I think that's great. And I'd like to see what I think is, I think this is a no-brainer, and if it goes up, then that's free money, and you can use it to buy a bull call spread or something like that. If it doesn't go up, you're going to be, okay, I'm stuck in these, but meanwhile, your call spreads are going to get cheaper and cheaper. So this, to me, is no lose. It's like I take the put, and if it drops $20 more or $30 more, all that's going to do is allow me to take that same $7 I sold it for and buy a really good bull call spread. Right now, I could buy the 165, 17, and the 185, so I can buy this $20 bull call spread for $7, the 165, 185. So I could play that right now, but so what I'm saying is I get $7 for free. I could buy this bull call spread and get $20 of upside for the same $7, so I'd have net zero on that. But what I'd rather do is take the $7, and if IBM goes higher, I'm still going to buy this bull call spread. I'll just pay a little bit more. If IBM goes lower, though, maybe I'm going to get the 140, 160 bull call spread for $7. Then I'll be super happy, right? Because I know I'm confident with that one. I'm fairly confident with 165, 185, but I'm super confident if I get 145, 165. I almost feel like that's money in the bank. And it's just a matter of time. IBM is spending a huge amount of money on R&D. They're doing a lot of stuff. They've got all these different divisions. They're revamping the company. So it's a matter of patience. So you've got to be a 20-year player. And I'll bet you'll see Warren Buffett buy more if it goes any lower. At the moment, this is around where Buffett started buying, about 150. Let's see. They said $10 billion on Watson. Yeah, I'm not surprised. I mean, Watson is going to take over the universe. So if it's, I can't emphasize that enough. I mean, why? If you think about it, first of all, obviously, Watson can replace every single person you ever talk to at Burger King, right? Especially the drive-through. So any drive-through, there's no reason for anybody to be at the drive-through. That's just now the person on a walkie-talkie. What do? They take your order. You don't think Watson can take your order? Of course they can. They have millions of jobs. And those jobs, even at minimum wage, are, these are 24 hours a day. Don't forget, 24 hours a day. They got to pay. Let's do the math. You've got, I'm going to estimate, because McDonald's has like 50,000 stores. Let's say there's 10 times McDonald's. Let's say there's 500,000 stores with drive-thrus. There's probably a lot more, but let's just say. So there's 500,000 stores with drive-thrus. So that's 500,000 times 8 hours a day, okay? And let's say IBM asked for $2 an hour, okay? That's $8 million a day times 365. There you go, $3 billion. So, so for IBM just to replace the drive-through people at fast food restaurants with Watson, which will take your order, ask you, do you want fries with that, and get it perfectly right every single time, and save the company, if minimum wage is $8, they're going to save the company 75% of the cost of that employee, and they're only going to ask for $2 to replace them. That's $3 billion a year right there. Then now you move along to probably 10 times that many other jobs that could be done the same way. You know, receptionists, you know, different, or any kind of clerical work, legal, even they're saying though, even like lab, like the people who put all this information down for the nurses and places like that, law clerks, accountants. There's like so many different jobs where low-level work for that kind of stuff is going to be just done by a machine. But some of it's complicated. But do you want fries with that, or did you say you want pickles on your Big Mac? That's not complicated. That they're already there. And it's just really a matter of rolling it out, and then it's a matter of dealing with the incredible backlash from the social disruption it's going to cause. But is it going to happen? Of course it's going to happen. There's no point to those people. Okay, there's absolutely really no point to them having that job when you can have a computer that can do it just as well. All right, and so that's the future, and there's no way of avoiding it. But the bottom line is for IBM, that's the money. So yeah, I put $10 billion into that too, because that's just one little example of how they can make $3 billion a year on this thing. All right, so moving on. Yeah, they sold their PCs to Lenovo. Yeah, I mean, look, they sold it. They got rid of everything. They focus on what's going to make them the money in 20 years. That's what they want to be. They're like, what's the future going to look like? And the future for them is Watson. Cloud computing, storing everything on this big digital thing that's going to hold everyone's information and smart enough to know what you need when you need it. You know, to ask, you know, hey, I mean, look, I look up stock stuff all day long. I would love to have a little computer assistant that was smart enough to say, hey, Phil, I know when you're looking at a company, these are the 5 things you like to look at. So I already brought them up for you. You know, it's like all 5 screens pop up at the same time because it knows that, you know, it knows that because I'm looking at this chart, I must want to look at these other 5 things about the company. I must want to look at their income statement, the balance sheet, so on and so forth. And it brings it up on screens, puts it up, and then when I say, okay, great, thanks, and I say put them away, and it puts them away, or I say save it for later. Imagine how, I mean, look how productive that would make me. And that's the future. It's going to happen. It's just going to take time, as do all programs and things like that. I don't think IBM's really late to the cloud. I just think that they're, you know, it's just, you know, like everything. They're late to PCs. They're late to everything. They're a slow-moving company. But they don't care because they know that they'll, you know, if something is going to be around, it's going to make money, it's going to stay, they're going to do it. Cloud to me doesn't make money, and I'm sure IBM doesn't think they're going to make money on it either. You just need to be in it because that's where everything is. And the funny thing is, though, this cloud thing, when IBM was late to the party with the PCs, why were they late to the party with the PCs? Because they said this is stupid. They said personal computers are stupid. Everything should be in mainframes. Because they said distributed technology is dumb. What you need, you want distributed information with centralized technology. That's what we have today. What IBM told you was stupid. The PCs, in the grand scheme of things, were a flash in the pan. And now we have internet devices that hook up to a mainframe and tell us whatever we want to know. And all the programs run on the mainframe. They don't run on our local machines. IBM was 100% right when they said it was not worth their time to get into PCs. It was a blip. And, you know, you could argue and say it's this and that, but the reality is they probably, you know, they may have missed an opportunity, a short-term opportunity, but the reality was they saw it at the time. This won't last because it's not a smart model. It's not going to make it. You know, that was IBM's biggest mistake was really they were right. It just took us 30 years to see that they were right. Crazy enough, that's how long it takes to see something. Is KO overvalued? No, Coke's not overvalued. Coke's in a transition also. Coke's problem is that people are moving to sugar-free drinks and vitamin water and stuff like that faster. Coke owns vitamin water, you know. They're moving to things like that faster than they thought. You know what's killing Coke is they're not having into they didn't get into the coconut water stuff fast enough. And that's an incredible growth thing. It's a really huge industry. Coconut water is taking away a lot of some of their other drink sales. Also, that vitamin water category is super duper crowded. I don't mean just vitamin water. I just mean like all these different flavored waters that are out there now. That category is so crowded that even if Coke has a superior product, it doesn't matter. And they just don't own it. That's the problem. Also, they bought vitamin water when it was smaller. They don't own the space. They're just a player, and that hurts them too. So over time, I think that their bottling, their distribution, so on and so forth, I think they've got a lot of superior skills to do it, and they're just going to have to keep buying up their competition. That's the only way they're going to do it. You know, they have to keep buying things that work and marketing the crap out of them. But, you know, so they were priced ahead of themselves. Let's take a look at Coke's chart for a second. They certainly got ahead of themselves with pricing, but this is back down to when I liked them. When I interviewed the CEO of Coke a couple of years ago, and I loved them when they were down here. You know, when they were in the 30s, I called them a superstar. They just got a little bit ahead of themselves. But this is right. You know, when you have a stock as heavily traded as Coca-Cola and as heavily owned as Coca-Cola by institutions and such, you can probably assume that the 200-day moving average is not a mistake. This is a value placed on the stock over the last year based on millions and millions and millions of transactions by very big institutional players who have teams of analysts looking at it day in and day out. Now, what is a mistake is when it goes too far away from the 200-day moving average, and what's a mistake is when it goes too far below the 200-day moving average. But the 200-day moving average, that's the right price, and it's just been steadily going up, and it goes up too high and it jerks back, and it goes down. It hasn't really gone down too low. It goes down too low, pops back up, down too low, pops back up. This is the right price. All right, and it's a good company, and they pay a nice dividend. It's perfectly good to own. I would like to see them go a little bit lower. I'd love to see them come back and test 36. That's way too low. And if they're at 36, what do? We're going to sell the $32 puts. And we're going to do a little buy right, and you know, we'll do a bull call spread, and we'll be looking for them to be up around here in 2016-17. So even if they flatline, if we can catch those $32 puts down here, and if we can buy the 32.40 bull call spread, what we're betting is that between now and 2017, they stay above this line. All right, that's all it is. And again, we're not greedy, because we can make 20% a year by setting up a spread like that. We're also, because we can do that, we're also not in a hurry. We can watch it. I can afford to watch it and wait. I can afford to watch it because I say, look at that. They fell below the 50, so they're going to have a hard time getting back over 42. They're testing 40. They have gone below it before, not even too long ago, so let's see if they go below it. And if they go below it, that's when I start getting excited. When they get down to like 38, I'm going to start getting real interested. At 40, I'm like, if they have a strong bounce at 40, I'll get a little more interested because I'll say, oh, look how well they're holding 40. That was my premise, right? My premise is they should hold 40. If they hold 40 now, after the bad news, that's going to make me even a little more bullish on them. So dividend too low, is it? I thought they had a good dividend. Yeah, 3%. That's great for them. You know, you got to weigh your dividend. You got to take into account the fact that you've got a stock that's almost bulletproof. That makes their dividend more valuable. You know, if I get a 6% dividend from Pfizer, Pfizer could have a problem. Pfizer could have a bad pipeline. Pfizer could do a lot of stuff. Coke, no. I don't care if you say it's off a little bit right now. They're not going to go down 20%. Pfizer can go down 20, 30%. Coke is incredibly unlikely to go down 20%. So you got to take that into account too. It's your risk premium is higher in other stocks. Sugar. In fact, I talked to Kent. I have somewhere in the web. There's a whole interview of me talking to Kent about all this stuff. I asked him that at the time. He actually mentioned that there's not enough sugar in the world for Coke to use sugar. It's not about yeah, of course it's expensive. It just doesn't exist. You can't do it. They can't go back to real sugar for their drinks. There's not enough sugar. There's not enough land that they could grow sugar on. Okay, they're already using beet sugar because apparently beet sugar is easier than sugar cane to make. But you know, Coke's big R&D thing. They're trying to find something that's more like sugar that they can use. They're so into that. That's because the reality is people want something sweet. They don't like the way sweetness tastes in general, and so everybody's looking for that holy grail of a new sweetener. But sugar, that's why Pepsi too. Look at them. They have, you know, the Pepsi Free or Pepsi whatever it is. Not Pepsi Free, Pepsi Original, whatever they were putting out for a little while. It's only for a little while because they can't do it. They just can't put out that much sugar. Now, personally, I buy the Mexican Cokes because Mexican Cokes have sugar. The Coca-Cola for Mexico has sugar in it. Up in Jersey, it's real popular. Like, we all get these bottles, the old style big bottles of Coke. They deliver them to our grocery stores, and everybody buys them and pay. I don't know, it must be $1 something a bottle. I think it's $1.25 a bottle. But it's so worth it. It tastes like a Coke used to taste in the good old days. Let's see. Old stock CMG is the most attractive. CMG. I'm not a big fan of CMG, frankly. I mean, we play them up and we play them down, depending on where they are. But no, I'm sorry, it's a $10 burrito. At some point, you know, if the economy goes bad, they're not going. They just can't keep up that growth. So, I mean, I do like them. I mean, I liked them when they were a lot cheaper. I certainly don't like them at $600 though. Gazprom, you got to watch that P. I'm not sure it's going to actually hold up, and they've got sanctions and all kinds of weird stuff going on. It looks good, but it's scary. I got to wrap this up. So, wow, look at that. It's almost 3 o'clock. Boy, do I have to wrap this up. Jim says he has the IBM 160 puts short for 925, now 1570. Is there a way I can improve my position? Okay, that's a good question, Jim. Let's answer that one. IBM, January 16, 160s. Where's my thing? IBM, January 16. So the January 16 160 puts are 1560 something. So let's say 1560. So all you got to do is go to 217. Say what's 1560 and 217? Well, kind of, sort of, the 145s. So obviously you can roll down. Now that's 10%. It's not in the season. Now you can roll down 10% for free, or, and this is if I was doing it. It's $15. So what I would do is I would roll that to 1.5 times these 130s at 10. I think it would be 10. So I would want to roll to this. I would want to sell these guys for 10. It says 840 now, so I wouldn't sell it now because he's 816. So why would he be 840? And he's 1080. So what's between 1080 and 8? At least 9 something. So I would ask for 10 on these, and if I could sell. So in other words, what I would do is I would offer to sell those for $10. Now understand this. It's probably only going to fill if your 2016 puts get worse, right? Obviously, IBM would have to be heading lower for those to fill. So you're not going to be happy about that, but the point is that you want to get your fill and make sure you get it for a good price. But if you sell 1.5x of these for 15, you might take a little bit of a loss on yours because they're already at 15 something, and figure you might lose a couple more bucks on this. But what you're going to do is you're effectively, for no additional charge, you're going to roll to the 130s. And so you're picking up almost 20% in your position. And you have 1.5 times at 130 versus 1 times at 160. All right, so that's, let me see something. 1.5 times 130 is 195. So in other words, on whatever amount of shares you were buying, you're effectively buying $35 worth more. So instead of 160, you're getting 195 in total cost because you're buying 1.5 times the 130. Really not a big deal. So you're not adding much margin, you're not adding much total cost if the whole thing is assigned to you, but what you are doing is you're creating a buffer zone of 20% that makes you safer. So that's the way I would look at it. And by the way, or if the position's hurting you, you don't want to do that, there's nothing wrong with taking a $5 loss. You sold them for $9.25, so if you roll these at $15.70 down to these guys at $10, right? It's going to cost you $5.70, but you sold them for $9.25, so you still got $4 in the trade, and that means you just sold these for $4, and you won't get hurt unless IBM's below 130. So again, so somewhere between that nervous sort of move and my more aggressive move is what you want to be doing with these things. But give yourself a better buffer. Now, of course, if you were gung-ho that you wanted to buy IBM for 160 in the first place, I wouldn't worry about it at all. I still might take advantage while it's so expensive. I'd still probably take advantage of the 145s and try and do an even roll. But I certainly wouldn't be worried about the position because I think IBM's totally worth that much money. Mike says Watson can replace the House of Representatives and the Senate. Yeah, well, so could my dog, I think, basically. It's just insane. My daughter, in fact, it's funny, my daughter was just saying the other day at dinner, she's taking she's in high school now, so she's starting to have teachers talk about politics. And she's just like, it's not fair. Why can't we run things? We know it's our future. We should be allowed to make all these decisions. And I'm like, I said to her, I'm like, well, I guess kids do a worse job. It's not like, it's hard to, the old argument is they have age, they have experience, they have this and that. They're a bunch of morons. All these politicians, they're a bunch of morons, they're a bunch of babies, they're the worst of the worst kind of people. It's like, yeah, we probably should at this point throw the whole system out and let children run it. It's like, it just can't be worse. They're not going to make worse decisions than these people. Oh, please don't tell me Russell's hitting new highs. Are you kidding? I'm going broke while I'm doing this? All right. That's all right. I'll live. No, it's 107.30. That's about where it was before, right? So I'm not happy. From that perspective, I'm not happy about it. All the call centers too, yeah. Oh, that's right. All those call centers, all those Indians and whatever. Now, unfortunately, though, think about that when you've got all these robocallers, right, and all these call centers. You think they annoy you now? Imagine if it doesn't cost anything to call you 100 times. Imagine if there's no human effort required to call and annoy you. Now, on the defensive side, though, I can now pay Watson to answer my phone. So so somebody's paying to call me. I have my Watson's going to pick up the phone and talk to the guy and say, no, I am not interested in those magazines. Thank you. All right. So the rest of was heading down. What? Why are you doing this to me? What do you mean? Yo Mama said Russell heading down, breaking below 1107, about 1165.50. Where the hell is that? Is that your prediction? And you think, why are you saying that anyway? 1107. 1165. 1165 is much higher, You mean did you mean 1065? Anyway, that's okay. Oh, I see, 1107. Okay. All right, now I got to quit. Yeah, we can't run these tapes for 2 hours. Anyway, so thanks, guys. Okay, that was good. I enjoyed that. That was a good back and forth kind of session. I really enjoyed it. And we will come back and reconvene next week. Let's take a look at the state of the market. Oh, yes, they're pulling back. Thank you. Oh, look at that. I'm going to be rich. Isn't that funny? That's the way trading is, right? Like, oh, no, I'm going to be broke. Now I'm like, oh, I'm going to be rich. It's going my way. So we'll see what happens. I'll fill you guys in tomorrow, let you know how this thing turns out. But I really, 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 really believe it's going to hit 1100. So for the sake of making $5,000 bucks, I am probably going to stick with it longer than I should. All right, guys. Well, thanks so much. Everybody have yourselves a lovely day, and I'll meet you back in the chat room.